analysis at ESM as well. Professor Dr. Jens Binder, EBI academic board member and chair in private law and commercial law and company law and securities law at the University of Tübingen. Welcome. And then Giovanni Sabatini, Director General at the Italian Banking Association, ABI, and member of the advisory board of the EBI. In his keynote address, the implications of the resolution framework and the common backstop for banks, Rolf will introduce the newest addition to the overall banking union framework for the Eurozone. Looking back, the idea for having a banking union was created and developed at the height of the sovereign debt crisis about 10 years ago. The idea based essentially on the realization that a monetary union like the Eurozone does not function properly without some form of centralization. Until then, monetary policy was centralized, but many other aspects of policy sectors remained national, including many aspects of the banking sector. Considering the fact that by having a joint currency, many policies in one country will have spillover effects on other countries, the member states moved on to create a banking union for the Eurozone. Banking union was also devised to ensure that slowly but surely, Europe will move to more integrated banking and capital markets. A banking union essentially consists of 4 key elements. The first one is a joint rule book. The second one, a single supervisor. The third one, a single resolution authority. And last but not least, a common deposit insurance. Leaving the common deposit insurance scheme aside, Europe made significant progress in all the other 3 elements. The SSM is supervising now all the banks of the Eurozone. We have a strongly harmonized set of rules with CRR and CRD4. And since 2016, there's also the SRB being the single resolution authority for the Eurozone. As part of the creation of the SRB, a single resolution fund was set up, funded by banks in order to finance a resolution scheme if necessary. Despite this fund having a target size of around about 50 to 60 billion, early on the discussion came up to devise an additional backstop for the fund for emergency cases. This was not as controversial as it is, of course, but it still contained some highly distributed topics which were finally approved now. I'm happy that Rolf and our co-discussants are speaking about this topic. And let me now stop here and introduce Rolf, who will introduce into this topic with his keynote speech, which will be followed up by a co-speech also by Nicoletta Mascher. First of all, Rolf, welcome again, and also Nicoletta, thanks for being here. Rolf Strauch is in charge of economic and market analysis and economic risk analysis at the ESM and the ESFSR. He presents the ESM and EFSF in European fora and also negotiates with member states. Prior to his work at the ESM, Rolf was working at the European Central Bank and at Deutsche Bundesbank. He also worked as a researcher at both the University of Mannheim and the University of Bonn. He holds a PhD in economics from the University of Bonn and is a fellow of the European Integration Studies Center in Bonn. Nicoletta Mascher is head of financial sector and market analysis division within the chief economist's department of the ESM. She is responsible for monitoring financial sector conditions in the euro area and providing advice on key developments to board members. Within the management team, Nicoletta is participating in designing policies for the fulfillment of the ESM strategic objectives and in execution of the ESM post-program activities. She is also heading the country coordination team for Ireland. Prior to her work at the ESM, Nicoletta also worked at the ECB, where she was a joint supervisory team coordinator for banks in several large countries. Nicoletta holds a degree at the Bocconi University in Milan, and that's where she also received a master's degree in economics, and she's a chartered accountant and auditor. So with these introductions, I thank all of you again for participating, and first I would hand over to Rolf for introducing them to this topic, and then followed right away by Nicoletta. Thanks very much.
Thank you very much, Thomas, for the kind introduction, and welcome to all the participants here from Luxembourg. I'm here with my colleague Nicoletta Mascher. We are separated by a plexiglass wall to So safety standards are all observed. No worries about that. Today's discussion is about the ESM common backstop to the Single Resolution Fund. The ESM common backstop to the Single Resolution Fund is a significant strengthening of the financial infrastructure and the safeguards of banking union. I think that is the key point we want to explain today and the key takeaway. So understanding why this is a good step, a good point to have at this stage, and also what it means, how it works. So I will first say a few words on the circumstances of that decision and why I see this as an important decision to advance the introduction of the common backstop and now put it in place at this stage. And for that, let me make a few points about the state of the banking sector and how we currently look at it. And we know that the banking sector in this pandemic crisis has played a much different role from the last crisis. In the last crisis, in the financial crisis, and later on it was the banking sector was rather part of the problem than the solution, while we know that this time it was different. So what led to that result? We know that as a follow-up to the past crisis, a lot of measures were taken to strengthening the safety of the banking sector. And the most evident that we know, or where it's most obvious, the improvement is, for example, the increase in capital. The capital ratio basically doubled over the last decade, and that was one of the key points why, at this stage, the banking sector was able to lend during the crisis. But that was not all. And on top of this, there were a number of policy steps taken to make that possible. Part of those policy steps is the action of the supervisor, where actually that provided some capital relief. Another action is that of governments that provide guarantees in order to kind of ring fence the banking sector. A third step on top of that is the fact that cheap funding is provided by the ECB. But what that all says is that, so to speak, the policy world counted on the banks in supporting the economy, and this is then a role that the banks took up. They were, however, much better prepared for taking it up than they were in the past. So through the strengthening of the governance structures, but also of the capital endowment. A second important point is that banks had managed to reduce the legacies of the past and reduce the non-performing loans that they held on their books. So which actually, over the past decade, had returned now to levels that were relatively close to what they were before the past crisis. So in terms of numbers, that if you look at the largest banks, then the median is about 3.2 percentage points, and in the third quarter of 2020. We have, however, also to acknowledge that this is not equal across all banks. Overall, it's a great and excellent result, but there are still some banks also that have to work further on this, and that obviously also implies a somewhat higher degree of vulnerability. So that overall there is a strong banking sector, but nonetheless there is also reason to be alerted, and that is the key point that I want to make. The strengthening of the financial infrastructure with the ESM common backstop is a measure of preparedness and alertness. It's not a measure of being alarmed and distressed or thinking about systemic distress, not at all. But it's good to be prepared because we don't know exactly what this crisis will bring along. It's clear that risks increase, and we will have to see what it actually implies in terms of non-performing loans, what it means in terms of bankruptcies. We know that past years, numbers of bankruptcies have kind of gone down, which looks counterintuitive, is the consequence of many policy measures taken. But those effects will be felt at a later stage when they are phased out. And if you look at the US by comparison, for example, we notice that the number of bankruptcies among large firms last year was as high or much higher than the entire decade before until 2009. So it just maybe gives a sense of what may be coming up, so that there will be a significant increase. It's not visible yet, but we have to be prepared for this to happen. And here are 2 points that maybe are worth highlighting as well in terms of being alert. So the capital structure and the amount of capital has very much improved. That is absolutely correct. And with that also the loss absorbing capacity. But still, in the overall process of creating banking union, implementing it, it is also true that banks are still in the process of building up MREL, and so the bail-inable amounts that they have on their balance sheet. The process is well advanced, but we are not fully there yet. The second element, and here it becomes more structural, and this is from our perspective, a more important point, is profitability. And here we have to notice that profitability in the European banking sector, for a number of reasons, is still rather anemic. If we look back at last year, September, it was on average 1.8% in kind of return on equity, which is way too low to be attractive really for investment. If you look at equity pricing, it has dropped last year, has very much improved towards this year, 70%, but still it's 15% below what it was before the crisis. And the price to book ratio, which is one measure of how markets look at banks and what they expect in terms of profitability, is about 0.5. So, which shows when you compare to the US, where it's above 1, that indeed there's relatively market trust in the European banking sector, which in turn just means that in forward-looking, unless something happens, the banking sector has limited own capital generating capacity. For all those reasons, as I said before, it's good to be prepared and to be alerted, but there's no reason whatsoever in order to be kind of completely alarmed or distressed on the situation. So this is, so to speak, the environment why I argue it is an important decision what the Eurogroup decided in December last year to actually advance the introduction of the common backstop, and why it is a significant step forward in the financial infrastructure and the safeguards of banking union. Now, the common backstop was actually expected to be implemented at the latest at the end of 2023. That is foreseen in the BRRD. So this is now is expected to be advanced by 2 years. This is, from our perspective as ESM, part of a bigger decision on strengthening the structure of the ESM. So next to the common backstop, another element is that the ESM forward-looking will have a stronger role in any future program that would develop with sovereigns. In future programs, the ESM, next to the European Commission, will be looking into policy conditionality and signing the MOU. And we will do so in cooperation with the ECB, but it's basically those two institutions that will be more in the driving seat. In that context, also, we have some broader monitoring capacity. A second element of the ESM reform that was decided is to look into our precautionary instruments. And here we are now in a situation where the precautionary toolbox is more geared towards acting preventively. In this context, also, we have last spring, developed this instrument of a pandemic support line, where this becomes very evident. Now, for the banking sector, more specifically, there's also another change here. And that change is that with the introduction of the common backstop, another tool that the ESM has, which is the direct bank recapitalization instrument, that will cease to exist. The direct bank recapitalization instrument was devised in 2012 or the discussion started then, in order to do direct bank recapitalization from the ESM to the banks. But that was before the banking union actually was developed. And I think now it has basically, it makes a lot of sense from our perspective and for the efficiency of working overall to kind of stop that and move on to the common backstop setting. As a common backstop, we will provide financing to the Single Resolution Fund, and Nicoletta will explain the mechanics of that. But here is also how it goes in the overall picture with the ESM, because obviously we are a financing institution and going to the market, and we have broad experience in that and have successfully done that as an issuer. So from that perspective, we are well placed to be this kind of fiscal backstop that to the Single Resolution Fund that in other countries the National Treasury function has, which we don't have at the European level. So this is how it fits into the overall ESM picture, that there is a change in our instrument. The role as a common backstop goes in line with the otherwise revision of the mandate and a strengthening of the ESM. As a last small point before I turn to Nicoletta, is that obviously the backstop, common backstop, is a significant step forward. It's not the last step forward that we need to do on banking union. Thomas mentioned before EDIS, and we know that EDIS is still a missing backstop, still a missing leg of financial safety that makes banking union work better. We think on top other changes are necessary and should be part of the package, which relate to a resolution, but also which relate to better integration of the European banking market and avoiding barriers to cross-border activity, avoiding barriers to cross-border merger. If you can get there, all that will help to make banking union work better, will make the financing of the economies more efficient. But these are discussions that are currently ongoing, and the Eurogroup has the task of proposing a work plan, a time plan for that, to the heads of state and government in June. So far on the context, on what it means, the backstop for us, and now I turn to Nicoletta to explain the mechanics.
Thank you. Thank you, Rolf, and good afternoon, everybody. Thanks for having me here today. So Rolf has just reminded us of the conditions of the banking sector in the banking union and highlighted the benefit of completing a banking union for a more stable and a more efficient banking system in the euro area. And I would like now to focus on the second pillar of the banking union, the resolution framework, and how the backstop can make it even stronger. Moving resolution to the European level has helped to strengthen the system and to make all the stakeholders more confident that the system can handle failures of banks in an efficient and orderly manner, while avoiding contagion effects. Given the architecture of banking union, the resolution regime is financed by the banking sector itself. And this happened through the annual contribution to the single resolution funds, and access to these funds can only be granted when bail-in rules have been applied, so that shareholders and creditors have to bear part of the losses. So the loss absorption capacity in the system, thanks to the resolution regime in place, has greatly improved. However, there may be situations where these funds are not sufficient in order to successfully execute a resolution strategy. For instance, when the resolution board has to use these funds for multiple large banks, or when there is a major severe crisis in the system. So this is why back already in 2013, the backstop was approved. And the purpose of the backstop is actually to double the resources available to support the resolution in the banking union, which are targeted at 1% of total covered deposits of all institutions authorized in the banking union. So let me explain a bit more in detail how the process could work. When a bank gets into distress, either the ECB or the SRB has to decide whether the bank is failing or likely to fail. At this point, we could already receive a pre-notification, a source of advance warning that resolution may happen and our funds may be needed. So this pre-notification will allow us to prepare. However, the process could only start when we receive a formal request for a loan. And this will happen once the SRB has made a decision whether there is a public interest in resolving the bank, and there are no other measures available, either private measures or supervisory measures, to restore the viability of a bank in a timely manner. So at that point, we can start instructing our decision making, and we will produce jointly with the SRB the assessment of the repayment capacity, hence the assessment of the ability of the SRB to recoup the funds through ex post contributions that will be levied from the industry by the SRB itself. This means that since the SRF is fed by contribution from the banking industry, the banks themselves will remain the ultimate debtor of the ESM. So from these mechanics, you can already see which the main features of the backstop tools are. Namely, it is a last resort tool because public assistance may only be sought when the SRB has depleted its funds. This means that all its funds have been already committed to resolution actions, or the SRB cannot contract borrowings on acceptable terms, according to its own assessment. And it is fiscally neutral because public assistance will be entirely recouped through ex post contribution from the banking sector itself. Another important feature is that these funds will be immediately available. The time frame within which we have to disburse and to make first to make a decision on the repayment capacity assessment and then to disburse is 12 hours and can be extending only up to 24 hours. It is immediately available, and it is available for any of the purposes set forth in the single resolution mechanism regulation, even for liquidity purposes, although in this case there are additional safeguards envisaged. Finally, I would like to highlight two additional elements that have been envisaged in order to make the disbursement process and the repayment capacity assessment as robust as possible. And these are the pre-monitoring framework that we are setting in place together with the SRB and the early warning system. What is the pre-monitoring framework? With the pre-monitoring framework, we will be assessing on a regular basis, prior to any disbursement, the repayment capacity of the backstop. And this will be done according to a well-established and well-crafted methodology, considering different scenarios that may materialize and may trigger the use of the backstop. Secondly, once a loan is outstanding, we will be running on a quarterly basis an early warning system in order to make sure that the SRB can always adhere to the debt servicing schedule according to a set of debt service cover ratio requirements. And with that, I would like just to recap that for all the reasons that we have highlighted, the common backstop will greatly enhance the resolution framework, make it more robust. And it will also help in a way to decouple the nexus between banks and sovereigns, because as I said, all funds will be entirely recouped from the banking sector, and hence shield government in a way from being forced to come to the rescue of the failing banks in their own countries. Finally, as Rolf has highlighted, it is a common instrument, so it is fully consistent with the architecture of banking union. It is centrally administered and is well safeguarded by a robust risk assessment framework.
Thanks very much, Nicoletta and Rolf, for this opening keynote speech. We're moving on now to a Q&A session. We have now round about 35 minutes for this. We are finishing at 1 o'clock with this session. I will also bring in the other co-discussants, obviously, into this discussion. To the audience, if you want to ask some questions, we have the Q&A tool. You can just include some of your questions in this regard, and then I will read them depending whether they fit into the discussion. Yeah. But let me now, first of all, kickstart that discussion with one question to Rolf, but also to Nicoletta. You mentioned this as an additional safeguard, the backstop as an additional safeguard within the overall banking union framework. So, but we have now, let's say, a European supervisor, we have the European resolution regime, we have quite a significant amount of money in the single resolution fund. So is this literally just some kind of a backstop if something really bad is happening, or do you see this as something really practically relevant in the day-to-day work? I mean, you described this, obviously, the way it will function, but my question is how you see this practically work, yeah? And then also maybe in terms of comparison, because you mentioned now this is a new additional tool for the Eurozone, how is this done in other, let's say, significant jurisdictions which have a banking system of substantial size like the UK or the US? How would we see a similar tool in these respective countries?
Maybe I take that up, and I think I'm glad that you also immediately made the point about the comparison with other countries. So if you look at the US experience, for example, so there is the FDIC as the resolution authority, and then they have basically a treasury line as a backstop. As I said before, we don't have this kind of European treasury function as they have in the US per se, so this is ESM. They have the backstop and they have the reassurance, but in the US it's also very rarely used. I mean, I think it was I don't know precisely, I think it was used in the 1990s, but not more recently, very clearly. So, which means that it's a matter of preparedness and it's a matter of giving reassurance that the system can work and actually does work, also when problems come up, bigger problems come up. And in that regard, I would say the way you put it is is it practically relevant? Of course it's practically relevant because we should be having it there as a safeguard. Does it mean that it will immediately be used? Not that I would count on it, because as you rightly also point out, and as Nicoletta said, there is indeed the Single Resolution Fund is ramping up its resources through the contributions. They haven't been used so far, and we will see how it will be used forward-looking. But nonetheless, it is very good that you can count on this unified structure being in place in order when bigger problems arise. That would be my characterization.
Thanks very much. But one of the points or aspects I would like to bring into this discussion, you mentioned this is obviously something which ultimately goes back to the banks. So there is not really the European taxpayer on the hook, if you say. So you could say European banks are on the hook if something goes wrong, and then they would have to repay this via additional levies in order to pay back essentially the credit line to the ESM. But it's kind of Europeanized, yeah. But then on the other side, obviously you have still a strong influence by national authorities and national member states on the banking system. Yeah, I'm not speaking about now, let's say, CRR and CRD, which is to a great degree Europeanized. I mean, there's implementation with CRD, of course, but there's a great degree of European rules, but there are still other rules like insolvency regimes and other regimes which directly affect banks as well. Is this something where you say, okay, this needs to be more Europeanized as well, because now it's not only, let's say, the national banks which have to pay back a credit line to the ESM, but it's really European banks which have to do this. How do you see this?
I think this relates to an argument that Nicoletta made, and maybe Nicoletta, if you want.
So I understand that your point is about the harmonization of insolvency regimes across the banking union to make the system even more unified and homogeneous. Yeah, and absolutely. I mean, this is one of the next necessary developments in making the resolution framework even more robust and more complete. And this is actually part of the current discussion about how to move forward from the current resolution regime, which is well crafted and now made more robust with the backstop, but still incomplete because there are situations that cannot be handled swiftly and in a harmonized way across Europe because of the differences in the insolvency regimes, the differences in the deposit guarantee schemes, and in the way the deposit guarantee schemes can be used for resolution actions. So in this respect, we agree with the view that there is need for more harmonization across Europe, and there is a need for devising let's say, universal tool to handle the failures of banks across the banking union.
But maybe if I just may add this to make really clear the point that I think that you made before when you ask for national and European responsibilities, right? So imagine us 10 years down the road, there is a big bank in the euro area that is supervised by the SSM that goes into trouble and that will be resolved under public interest by a European institution, the SRB, with the money then available in the single resolution fund. Suppose at that stage there would not be the possibility of drawing on a euro area backstop, but as under the current arrangement, there would be a national backstop for that big bank. I think here you feel how the incompatibility or compatibility of institutional setting would work, right? So you have a European supervisor, you have a European resolution authority, and then you would suddenly turn to the national authorities to be the backstop. So, and that is why actually from an architectural point of view, this also makes a lot of sense. This is why it was originally already foreseen as a setting in the BRD. So, and just now this step is advanced and we now got that role. So I think that from that perspective, it's fully compatible. And on top of that, what Nicoletta said about the harmonization clearly plays a role.
Thanks very much, Max. Absolute sense. One question from the audience, from the Q&A tool, and again to all the other ones, if you have questions, please type them into the Q&A tool. So a question from Josef Bergmüller is now, a lot of the ESM's credibility is undermined by its decision-making rules that could be impractical in crisis situation. Yeah. So every deployment has to be approved by a majority of the Eurogroup first. And you know by experience, that's not always very easy. Yeah. Do you see this as a big obstacle in a big crisis situation, that essentially you always need a majority of the member states to approve this respective? Yeah, they will probably have their own views when the crisis arises about this as well. But how do you see this this topic? Thanks, Josef.
So I can say a word and then I hand on to Nicoletta, who can go again through the decision-making process. I do understand the question very well. From my perspective, after 10 years in the EFSF, ESM, I must just say it's true as a conceptual concern, but effectively in the past, when it really then was necessary, it has always worked. So that the practical experience is, in case of need, yes, you can take those decisions. That's what I just kind of say as from a more general point. The second point is, and here it's also very clear, is that the process is such, and there have been a lot of steps being made in order to ensure that it can be taken at short notice. And there's no intention whatsoever of ESM kind of rerunning and re-examining the resolution decision per se. This is about dispersing funds for which there should be some safeguards, conditions precedents, and so that a decision can actually be taken quickly. From that perspective, I'm confident that it will work. But maybe Nicoletta can say a few more words on how the process practically looks.
Yes, and maybe Thomas, I don't know whether you want to put on the slides with the decision-making process itself.
Maybe Ricarda, you can put them on the screen right now.
And I will start adding a couple of points that, in my view, make the process very robust and very efficient, so that to avoid any delay in disbursement. I would go to the second one. Next slide, please. Yeah, thank you. So I think there are at least two important points to make, to give reassurance about our ability to make a decision during a resolution weekend, because as I said before, the timeline is very short, and we will need to be extremely efficient in making the decision. First point I want to highlight is that when we receive the request for a loan, so once the SRB has made a decision on the public interest test and the use of the funds, at that point we will also receive an important set of information about the resolution case at hand, and that will enable us to very quickly instruct the procedure. And this is not something we will do on the spot in the 12 hours, because as I said before, there is a pre-monitoring framework in place, according to which we will assess on a regular basis, as soon as the backstop facility has been fully endorsed, so already in 2022, we will start assessing on a regular basis and at least once per year the repayment capacity of the backstop under a potential extremely adverse scenario, meaning a breaking point scenario where the backstop may be triggered. So this means that if we are approaching a situation where we believe that the backstop may be triggered, we will already have the assessment available, because there will be an escalation process in place that will enable us to increase the frequency of this assessment. So basically, in our framework, once we receive the request for a loan, we will already have the assessment ready for instructing the decision process. On top, we can also go back to the SRB to ask for additional information in order to refine the assessment if this is needed. And we will also have a role as observer in the extended executive sessions that will decide upon the resolution case. So with this information, we will produce a draft proposal for our managing director together with the SRB. And at that point, there may be also a decision about approval by qualified majority. So in most cases, the approval will be by mutual agreement. But if there is an assessment, either by the Commission or by the ECB, that failure to disburse in a timely manner could pose a threat to the euro area sustainability, then the approval can go by qualified majority. And as soon as the SRB confirm that the resolution scheme has entered into force according to the initial request, the managing director will inform the board of directors, and we will proceed with the disbursement. So I think that the process is very well safeguarded in order to make this possible, although it may seem impossible.
Thanks very much, Nicoletta, and thanks for answering these questions. I would like to bring in now our co-discussants. into this group, and we basically also asked them to give us their view about the common backstop. I introduced both of them already, Professor Jens Binder and Giovanni Sabatini. Maybe, Giovanni, we can start with you. I would hand over to you for a co-statement on this, I would say 5 minutes, so we can then continue our discussions after also Jens Binder spoke. So Giovanni, maybe over to you.
Thank you, Thomas. Good morning, everybody, and thank you for the invitation. Well, when we look at the important and ambitious banking union project launched in 2012, we feel a sense of urgency to complete its 3 pillars. And this feeling is even more acute in the present circumstances, as well as we all understand how critical will be a well-integrated banking and financial markets for support the relaunch of the European economy in the current circumstances. And therefore, we welcome the agreement on the common backstop to the Single Resolution Fund. This being said, however, when we consider the second pillar of the banking union, the Single Resolution Mechanism, I think that the situation is still unsatisfactory. And this assessment has been recently shared by the EBI, the Italian Banking Association, with the German Banking Industry Committee. We recently published a common document where we also formulated some proposal. Today, for the vast majority of the banks in the EU, in the event of a crisis, the normal scenario is a liquidation under national insolvency or national liquidation regime, as has been noted also by Nicoletta. And because most of the banks, particularly medium and small-sized banks, probably will not pass the public interest test. So the national banking insolvency or national banking liquidation regime varies across jurisdiction, and the coexistence of the common resolution framework with a plurality of national regime could generate dysfunctionalities and may give rise to inefficient, costly, and heterogeneous outcomes with serious economic and social impact, especially if the existing instruments and regulation are not applied uniformly. So a change in the legal framework is therefore appropriate and urgent. Solving potential inconsistencies and creating an harmonized insolvency regime, not only for banks under the direct remit of the Single Resolution Board, appears essential for both the banking union and the capital markets union. And in this respect, a step-by-step approach is needed in order to identify the areas where further alignment is urgently necessary. However, in our views, to fix the existing framework and review the second pillar of the banking union, there is no need to create a new institutional setup. Particularly, we consider that a transfer of resolution powers from national authorities to the Single Resolution Board for small and medium-sized banks appears counterproductive and not in line with the principle of subsidiarity. We think that as the single supervisory mechanism is functioning well with the 2 layers, the single supervisor with direct responsibility on systemically important banks and the national competent authorities responsible for the supervision of a less significant institution, this scheme can be replicated also for the resolution or to address crisis management for less significant banks. So we think that there is room for a solution where common administrative procedures for a more homogeneous bank insolvency regime can be stressed, and in which national deposit guarantee schemes could also play a primary role in managing banking crisis compared to the status quo. In this respect, I think also the reference to the comparison with what happens in the United States is very helpful. We think that if national DGS could be endowed with powers and tools similar to the FDIC, that will help to minimize the impact of the crisis of a small bank. In the United States, the liquidation procedures is the last resort tool, while other tools are available, like the purchase and assumption tools. So here, if we could have a more harmonized regime also with regards to the intervention of DGS as a tool to minimize the impact of a small banking crisis, would be extremely useful. So to summarize, I think that a targeted European banking solvency framework with an enhanced role for national DGS could deliver substantial benefits. So the objective of this reform should be to provide for alternative instruments for national DGS in addition to the mere liquidation. And also the strong role of institutional protection scheme, IPS, in preventing banking failures in the first place should be respected. So a crisis management system with broad mandates of DGS would support the EU Commission's aim to strengthen the banking union without changing the institutional setup and to complete in a practical way the second pillar of the banking union. Thank you.
Thanks so much, Giovanni. A player for a combination of European and national authorities for subsidiarity, and essentially also for keeping the current institutional framework in some aspects. Thanks very much for this. And then I would hand over to Professor Jens Binder, who would provide us his view the academic side of this topic.
Well, thank you. Thank you very much, Thomas, for this introduction, and thanks for having me. It's a pleasure to be here. I think what I wanted to say has very much ties in with what has been said before. I think when we look at the picture that is present right now, the impression that we get is ambivalent. We have mixed precedent in that only one case has gone to resolution proper, Banco Popular in 2017. We've got a number of cases where the banks did not pass the public interest test and therefore went into winding up under the national laws, which, as has been said very correctly, looks very different from country to country because there are so many different procedures and different roles. And in this regard, I couldn't agree more with what Giovanni has just said. In fact, this is a subject of ongoing research of mine. I refer you to a working paper which will be out shortly. Now, turning back to where we started, I guess, looking at the common backstop and at the situation that has been analyzed by Rolf and Nicoletta before. I think it is important to say that the implementation of the common backstop is really a crucial step forward in that it basically removes one major potential obstacle to swift and proper application of the resolution toolbox to banks which size clearly and interconnectedness clearly would make them meet the public interest test. So for those banks which are within the scope of the single resolution board, I think the introduction of the common backstop is a crucial step forward. But one point of caution in this regard, I think it will be very important to define common principles on the use of the fund. And this may be difficult in view of very different views on what the SRF and the SRB actually should do in each particular case. Of course, we do have a list of potential objectives and uses of fund money in the regulation, but still how these different uses and how the different objectives to be pursued by the uses, by those objectives are to be prioritized in each particular case, I think differs very much and depends very much on your individual view on what the board actually should do in view of the cases. And of course, it is difficult to predict how this is going to look like in the future because of the huge amount of discretion that is granted to the board. Now, it is certainly true, as Rolf has pointed out correctly, that very dramatic progress has been reached so far in terms of the resilience of market participants, and I fully agree with his view that this is something rather positive. And this applies across the board of indicators that have been examined in the latest monitoring report on risk reduction indicators presented by the Commission, the ECB, and the SRB in November 2020. The NPL ratio has gone down, the MREL has gone up, the capital position has improved, as has the leverage and the liquidity position. So we see a vast degree of progress here. And in my final minutes that I have, I'd like to maybe discuss a little bit how this translates into the prospects for bail-ins in the future, because as we all know, the bail-in tool is clearly the core element of the resolution toolbox. And if we cannot get this tool, which has not been applied, to work, then the whole exercise of having a single resolution mechanism may prove unsuccessful in the long run. So if this cannot really work, there's very little hope that we can deal with the very large cases that may happen in the years to come. Now, I think the first point to stress here is that a reliable basis of designated bail-inable debt is really essential in order to prevent systemic repercussions triggered by a bail-in. I mean, we've seen in Italy and we've seen in Cyprus how much risk there is in terms of involving retail investors with their savings and their claims against the failing institution in the loss sharing. We've seen, and I think we've learned, that this is something that must be avoided at all costs unless we want to trigger either severe public policy considerations which may preclude a bail-in politically, or trigger capital flights as we've seen in Cyprus. This is something that needs to be prevented, and for that we need a reliable basis of designated bail-inable debt instruments. And in this regard, I think it is worth looking at the detail of the figures that were presented in last November's report. There are huge residual differences left among member states in terms of both the quantitative indicators, the differences in terms of MREL target and target shortfalls, as there are differences in terms of the qualitative indicators. The composition of MREL across member states looks very different, and this applies in particular to the level of subordinated debt instruments. And I think if it's not possible to actually remove those differences, the proper and reliable implementation of the bail-in tool is likely to remain difficult for some time in the future. And there's certainly a rather long way to go before we reach sustainability in this regard, before a really sustainable market in bail-inable debt instruments within Europe, in all parts of Europe, in all different parts, with different banking systems and funding practices and so forth, is established. Then a lot of research has been published on the many remaining difficulties that come on top of this. Let me just point very quickly to two important things here. There's, first of all, a very problematic trade-off between the high level of discretion granted to the SRB with regard to the calibration of the bail-in tool on the one hand and the pricing of bail-inable debt instruments. This is not likely to go away. There is a huge amount of difficulty in terms of the calibration of a bail-in in view of the valuation problem, something that we've seen also in the Banco Popular case, where the valuation of that bank was hugely difficult and hugely unreliable in many respects, which is now giving rise to protracted litigation. And all of this translates into one particular problem, and this is what I want to conclude with. You know, without precedents that can demonstrate both to market participants and stakeholders, other stakeholders, how a bail-in is going to look like in the future, it will be difficult to predict the economic outcomes of that. And it will be difficult to price bail-inable debt instruments once again. And precisely because of this uncertainty, the political incentives to avoid a bail-in for member states in particular, in my view, remain incredibly high. So that again, for that very reason, we may see extraordinary interventions which may preclude the emergence of reliable precedents. And this is a sort of trap that we have gotten ourselves into, and I don't really see right now how we're going to solve this. And this is irrespective of the huge merits of the creation of the commons backstop and irrespective of the rather positive outlook that we see when we look at the figures. Thank you.
Thanks very much, Jens, for this a bit longer last minute, but it was definitely worth it. Thanks very much for bringing also this player, for making the bail-in tool more effective. I think that's absolutely fair assessment. I would like to now move again to the Q&As, and we have here actually a lot of questions now in the Q&A tool. Let me start with one. It's more directed to the ESM. From Martin Constant, speaking in his personal capacity, emphasizes the time, the use and capacity of the FRS remains restricted, and the question of true liquidity support of a resolved bank arguably remains an outstanding question. How do you, from an ESM perspective, regard and weigh the ESM backstop to the SRF in this context? I don't know, Rolf or Nicoletta, who wants to answer this?
Just very briefly, so I can understand, and I can also to some extent agree with many of the points that Giovanni raised. We know that there is a concern on how resolution, insolvency will work forward-looking. Nicoletta has before said and made the point about the need for harmonization. Just to say that this is part of the political discussion, and that also has the president of the Eurogroup has made it clear on banking union is also a work stream that look at improvements of the crisis resolution framework, and question, for example, on how to deal with medium-sized banks is part of that discussion, and how one can we improve on that side. So this is really, member states are conscious about it. Second point on what Jens raised, also a number of important points here in defining public interest. But then what I want to be very clear is this question about the ESM and the backstop and the resolution decision per se, the decision of bail-in. It is not the role of the ESM to second guess what the SRB decision. As Nicoletta explained, we will be in contact with them, we will have the information. Our role is, when we have received the confirmation from the SRB that the BRRD is properly applied, to take a decision on the use of our funds. This is just whether we want to give the funds, and against the background of what the SRB has decided. So this is not in our remit to any kind of second guess in this respect. So in this regard, one must be very clear. We could not do that actually within the 12 hours that is available. I mean, there must be a clear confinement of the decision in this regard. I will not comment broadly on what you said about bail-in. I mean, my reading is, and as I said before, and you will refer to the November report, there is still some progress to be made for full implementation. At the same time, if I listen to SRB colleagues, the situation looks in a way safer and better and under their common regime than you portrayed it. But main point here is we will not second guess. Then there was the final point on liquidity support. As Nicoletta said, our funds can in principle be used for everything, but there is still an issue that needs to be addressed here. And this is also politically discussed if more liquidity means are necessary. Nicoletta, do you want to take up?
Yes, maybe I would like to add a couple of points on liquidity support. So we have seen that the backstop can be used for any of the purposes set forth by the regulation. This means that it can be used for liquidity provision. Of course, this comes with additional safeguards because liquidity provision can also happen outside the bail-in requirements. And this means that our loans will be shorter in maturity, up to 1 year, although it is extendable. And there will be additional safeguards, including a more frequent exchange of information on the recoverability of the funds by the SRB. And there will also be a step-up margin on the interest rates charged on the loans in order to increase the incentives for a swift repayment of the facility. But the question is about the size. So whether the size of the backstop is sufficient in order to cater for liquidity need in and after resolution. And there we can look at empirical studies that have been run also recently, where we see that in most cases, if we talk about idiosyncratic crisis, the firepower of the Single Resolution Fund and the ESM backstop will be enough to provide liquidity in resolution. The point is whether this can suffice in a systemic crisis where multiple large banks may get in trouble at the same time. And this is where we still don't have a tool to address these liquidity needs. This is not something we can do with the backstop. And I would say maybe something not envisaged from the beginning, because the entire resolution framework is geared towards dealing with idiosyncratic crisis more than systemic crisis. And for the part on liquidity and resolution, I would stop here. Maybe one more point about the comments raised by Giovanni on resolution regimes for small and medium-sized banks. Of course, we are following with great interest this discussion. There is a public consultation also on the many proposals that are on the table in order to cater for the resolution of these banks. We are not expressing any specific preference for one or the other solution. I think that all in all, the solution should be sought looking at the resolution objectives. And therefore, in the end, we need to look at a solution that can be the best possible solution for containing financial stability risk in the banking union, ensuring the level playing field, and following, let's say, the general principle of the internal market for banking services.
Thanks very much, Rolf and Nicoletta. We are now shortly after 1 o'clock, but allow me 2 more questions. I mean, one to Jens and one to Giovanni. One question from the audience, Jens, maybe directed to you, with a short answer if possible, is about how the judicial control would work in case of a decision to resort to the backstop. This will be subject to this, but do you have any idea how this will work in practice? So the question is now, what form of judicial control there would be?
I'm afraid I'm a bit at loss here. I don't see that there will be that much potential for legal review in terms of the employment of ESM funds in this respect. I think if it's about if there is going to be legal review problems, then it's on the one hand with regard to competition, state aid issues that will be raised directly against the SRB and the SRF, I guess. And then on the other hand, of course, there may be litigation going on in terms of the replenishment of the fund post involvement of an ESM, and this will also be an issue to be dealt with, in my view at least, between the banks and the SRF. So I don't really see any particular role for judicial review in this context.
Thanks so much, Jens. Then one last question, Giovanni. You're representing obviously here the Italian Banking Association. Now, kind of 1 year down the road of this crisis, how do you assess the reaction of supervisory and regulatory authorities in this current crisis so far? Is there anything which points do you see positive and which are more negative from your perspective? If you could be fairly short with the answer, if possible, then I would appreciate it. Thanks so much. Over to you, Giovanni.
Well, thank you. Well, I think in the first part of the crisis, the reaction of supervisors and regulatory authorities were very timely and positive, allowing all the flexibility of the regulatory framework. And this was very helpful to help banks to continue to support with liquidity households and businesses. My point is that today, I think that supervisors and regulators are looking too much at the risk of how to manage the NPL increase in the future, rather than try to prevent the formation of NPLs. What I mean, my concern is that today we have some rules, and I'm referring to the new definition of default or to the NPL backstop, that embedded a too mechanistic and procyclical approach in addressing the credit risk. So my concern is that the interplay of these rules can accelerate the formation of NPLs and doesn't allow banks to support firms or households with forbearance measures. So my point is that probably supervisors and authorities today, in the light of the continuing emergency, they should reassess whether the procyclicality embedded in some of these rules should be reviewed or temporarily suspended. So to be sure that monetary policy, fiscal policy, and also regulatory policies are still aligned in supporting the European economy.
Thanks so much, Giovanni, for this answer. And we have now more or less 1:10, so I'll close today's policy series. Thanks so much again to Rolf, Nicoletta, Giovanni, and Jens for participating and sharing their views about this. We have the next series, I think, 17th of March, and we look forward to see you again at this event. We will circulate, obviously, also separate invitations in this regard. So thanks so much, and all have a good afternoon. Bye-bye.